Hello everyone, welcome to Optiongig. This is your host Vivek Somani, part-time option trader by passion and full-time software executive by profession. If you want to learn how to generate consistent monthly income trading options while working full-time in your regular day job, then join me in this journey. In this session, we want to talk about the trade-offs in options trading, specifically focusing on the trilogy of risk, probability, and the profit amount, and how these three things are related in options trading. Once you understand these trade-offs, how you can make use of this to create your trades. First of all, why do these trade-offs exist? Because option trading provides us various options, literally, and each of these options involves certain trade-offs related to the risk, related to the probability of profit, and to the profit amount. And successful traders understand these trade-offs and they put up winning trades based on the decisions that they take for after understanding the trade-offs. So it's not like shooting in the dark. You really understand if you move a lever A, how is lever B going to react? Or if you want to increase your profit amount, how is it going to impact the overall risk in your trade? To be successful, it is important to understand those trade-offs and those relationships between these three. Right? So let's look at the basic definition of what do we mean by these three items. So risk, I think, is very clear. Risk means how much money is at risk on a particular trade. For example, if you bought a stock of $50 and you bought 100 of that stock, so it's a $5,000, because that's the amount of money that has been deducted from your accounts. So that is amount of money which is at risk. Next is probability of profit. That means what is the probability that you're going to end up this trade in profit, means at least 1 cent in profit. Remember, this is a probability, means you are making money. It does not talk about how much money you are making. That's the third portion, is the profit in dollar terms, means how much money are you making. Understood that my probability of profit could be 51%, but is that, am I going to make $50 as a profit, or am I going to make $100, or what if I want to increase it to $200? And then how do we make those decisions? So once we are clear with these three terms, let's jump into the first one. So what I want to do in this particular webinar is to make sure we keep one variable constant. Let's say in this particular example, we're going to keep the risk constant, and then understand how the probability of profit changes with the change in the amount of profit that you want to make, or the other way around. If you want to make higher dollar profit, then how the probability of making that higher dollar profit changes. Right? So keeping the risk constant, the probability of profit and the dollar amount of profit are two extreme ends of a seesaw. Means if you want to increase your probability of making money, the amount of money that you make, that will decrease. And we'll see an example of this in a trade. Again, if you want to increase the probability, let's say currently if your probability of profit is 50% and you're making $100, if you want to increase the probability of profit to be 75%, then the maximum amount of the profit that you can make will be less than $100. Okay, or it's conversely, if you want to increase the amount of profit that you want to make, then the probability of making that profit will be very less. For example, it's a lottery ticket, right? The maximum amount of profit or the money that you can make in the lottery ticket is 100, thousands, millions, but as and when the amount of the money that you can make keep increasing, the probability of making that money keeps decreasing. The probability of winning the lottery keeps decreasing. Okay. Now look at through an example of an option trade. So the trade that you see right now, in this case, we are selling a put vertical of Facebook, which is expiring on June 21st, and it's a 170 175 put vertical, and the maximum amount of profit in this is $1.80, means $180. This is the initial premium that you have taken by selling this put vertical. Okay, now the maximum risk in this trade is $500. Why? Because that is the difference between the width of the strike. So this is 175, this is 170, the difference between 175 and 175, there are 100 shares in this contract, so 5 into 100 is 500. That is the maximum risk in this trade. Now the maximum profit in this is $180, which is the amount of the initial premium that you have taken. Now as you can see, the probability of profit in this case is 57%. As you can see, it's mentioned here. I know it's not exactly clear, but this is a 57% probability of profit. Now the question is, if we want to increase the probability of profit, or if we want to increase the maximum profit, then how the other variable changes. Okay. Now let's look into the next slide and see how the change happens. So in this case, I'm looking at that the maximum risk is still 500, but what we want to do is to increase the probability of profit to be more than 57%. Remember, we had a 57% probability of profit in the previous one. In this case, we want to increase the probability of profit to be 77%. If you want to increase the probability of profit to be 77%, what do you need to do is to go and sell further out of money put. So instead of selling the 175 and 170 put, we have to sell 160 and 155 put. If you do that, the amount of maximum profit that you collect is reduced to $75. So that's a trade-off. You want to increase your probability of profit. If you want to do that, you have to basically reduce or your maximum amount of profit that you can make in this particular trade. Okay. Remember, the risk is constant. It was $500 in the previous one and it is $500 in this one. So keeping the risk constant, the probability of profit and the dollar amount of profit have inverse relationship. If you want to increase the probability, you have to be satisfied with a lesser dollar amount of money. Okay. So what happens in in such cases? What do the newbie traders do? So rookie mistake is the newbie traders go for a lottery tickets. In a lottery ticket means you have a huge amount of profit potential to make tons of money, but with the minimal probability of it happening. So newbie traders come in, they start buying lot of out of money calls. Why? Because the way out of money calls are very cheap. You can buy it for a few cents, and if the stock actually reaches that strike price, there's a windfall opportunity that you have to make tons of money. What newbie traders do not look at is the probability of that stock reaching that strike price. And since the probability of the stock to go beyond the strike price is very less, those out of money calls expire worthless. They do it a few times and then wonder why option trading is not working. What do I prefer? My preferred approach is to have a 70% probability of profit, because 70% gives you optimal profits amount for the amount of the risk that you take. Alright, let's look at the relationship for the next one. In the next one, now I want to keep a probability of profit constant and then see how the risk and the profit amount varies. So risk and the profit amount or the dollar amount are conjoined twins, Siamese twins. What do I mean by that? That means if you want to make more dollars, you have to take more risk. Or if you increase your risk, that's the only way you can make more money. If you keep a probability of profit constant. Let's look at an example. Alright, in this case, what we are doing is we are selling again and the 165 155 put of Facebook expiring on 21st June, and we are collecting $1.80 as a premium. The probability of profit in this case is approximately 72%. That means, and the maximum risk in this is $1,000. 1,000 because we are selling 165 and we are buying back 155. The difference between them is $10. 100 shares are in a contract, hence the maximum risk is $1,000. Okay. Now let's look at another scenario wherein we keep the same probability of a profit, but we want to make more money. Then how does that change? Now same FB trade. Now if I want to make more money, I want to increase the money to let's say $270. Remember, in the previous case it was $180. But if you want to make more money, let's say $270, then I have to take more risk, because now if you go further out of a money and increase the width of your spread from $10 to $20, see now it is 165 145. In a previous case, going back, it was 165 and 155. So since we have gone further out, we have increased the width of the spread, the maximum risk has also increased, but so is the maximum profit. The amount of initial premium you collected is now $267 and not $180. But that's the only way you can increase your dollar amount, is by taking more risk. So understand these trade-offs. If the probability of profit is constant, then to make more money, you have to take more risk. Okay. So takeaways is, for the same probability of profit, higher the dollar amount, more risk you need to take. Okay. Now rookie mistake in this case is the new option traders, they get too big on dollar amount without realizing how much risk they have taken in their portfolio. You never know what market would do. A black swan event will occur and those traders then get wiped off, and then they wonder why option trading doesn't work. When you're looking at the dollar amount that you want to make, also be cognizant of the amount of risk that you are taking in. Take in and make a trade in which you are comfortable with the amount of risk that you are taking in. Okay. Now my preferred way is, I do not let any maximum risk on any one ticker to be more than 5% of my net liquidity. Why? What if that ticker just go against my assumption, right? If my maximum risk on that ticker is just 5%, I have still 95% of my portfolio intact to stay in the game, right? I don't want to make a mistake wherein, I have gone too big on a particular ticker because I wanted to capture a lot more of a profits, because I had a very strong opinion on that, and I have not realized what the risk is, and that the ticker doesn't cooperate, then I'm completely out of a business. Okay. So stay small. Does not matter how much ever you know about the ticker. Do not take undue risk. Stay within just follow the position sizings. Pick up the position size for which you are comfortable with and stay within that limit. Alright, so let's look at the third one. So we talked about keeping the risk constant. We already talked about keeping the probability of profit constant. The third one I want to look at is, let's keep the dollar amount constant, right? So if I keep the dollar amount constant, then how does the risk and probability of profit works? Given the same dollar amount, if we want to increase the probability of making money, you have to take more risk. Okay, let's look at how does that happen. For example, going back to the Facebook case, I'm selling 170 put and collected $180. My probability of profit was 57% and the maximum risk is $500, because that's the width of the spread. 175, 170, $5 difference, 100 shares, $500 is the maximum risk in this trade. Now I want to look at another trade where I want to have better probability of profit, right? So there's a better chance of making $180, right? So this is another trade where I have a approximately 72% probability of profit. There's a 72% chance that this will stay above this. So approximately 72% probability of profit. Maximum profit is still the same, 180, but in this case I have to take the higher risk, because now I have to sell up a put spread and go much wider. Instead of a $5, I have to sell a $10 with put spread. So in that case my maximum risk is $1,000. So if you have to increase your probability of profit from the original 57% with the max risk of $500, if you increase it to 72%, you have to risk little more money. So the risk in this case is $1,000. Again, it is just a trade-off that you should understand when you're getting into a trade. Okay. So takeaways: for the same amount of theoretical maximum profit, to increase the probability, you need to take more risk. Okay. Again, the rookie's mistake is either they go too big and risk losing in a black swan event. Like I said earlier, is you go and accumulate, you want to increase your dollar amount that you want to make, and then you're increasing your risk. Or in some cases they stay too small and make just pennies, so that trade is not really worthwhile. What I prefer is again 70% probability of profit, not 5%, 10% probability of profit, but 70% probability of profit, with the amount of profit to be 1/3 of the maximum risk in a spread, right? For example, in this particular case, it's not the ideal trade because the maximum risk is $1,000. Ideal trade would be if I'm making a maximum profit of approximately $300. And again, this is an ideal. Right now the situation is not ideal, but that does not mean we cannot trade it. But just keep in mind that you still keep some money aside to take advantage of the ideal situations when they occur. Okay. So that would be an ideal situation, that you are able to collect 1/3 of the maximum risk with a 70% probability of profit. Okay. I think that's it. I hope you are able to understand how the probability of profit, the risk, and the dollar amount of profit are related to each other, and will be able to make better decisions once you have understood this trade-off. Thank you for your time. If you have any questions, please write it in comments or email it to optiongig@gmail.com. If you liked what you learned, please help us spread the word so others can also benefit from it.